guys, it's MADSTAR here. Today we're going to be learning about the basics of options. So this video is really targeted at beginners and people who really don't know what options are. So let's get right into it. So what are the main things you want to know about options? So the first thing is that options are basically a contract. So let's just have an example and go to maybe your favorite company that's listed in the stock exchange. Let's say Apple, which has the ticker symbol Apple, and it's currently trading at $237. So on the right over here, we can see days, 12 days, 19 days, 26 days. Let's just click on the 26 days. And what comes up then is an option chain. So on the right here, you can see all these different strike prices. And what you'll see on the left side and the right side is calls and puts. So you can buy these calls, you can buy these puts, but you can also sell these calls and sell these puts. So I don't want to make it too complicated, but basically when you're buying calls or buying puts, you're buying premium. What I mean by that is, let's say you're buying a call. So let's say you want to buy a call for 240 in the next 20 days. That means that you're going to be paying 6.15 cents for every contract you purchase because you think that the stock will go above $240. So, and essentially options come in 100 pairs. So all the numbers that you see here, you have to multiply them by 100. So to buy this option contract, you will think that your stock will go, Apple stock will be above 240 in the next 26 days. Therefore, you'll have to pay $615. Now, you can also decide to sell this. So you're betting against the other person, basically. And you think that the stock will stay under $240. So when you're selling this call, you are going to be receiving $650 in advance. And as long as the stock stays above $240, your selling of the call is in the money, and therefore you'll be making $650. But even if it goes to $240.22 and by the expiration date, it will no longer be in the money, and therefore your option will expire worthless. And the same will work on this side. On the put side, if you're buying a put, you're predicting that the stock will go down. So let's say you think that the stock will go under 220, then you're going to be paying $261 for it to go below. And you can also sell this one and you'll receive $261, and then you're betting that it'll stay above this price. So that was the basics of this. And what I want to tell you just in advance is that when you're selling options, you're keeping time in your side, and you're just gonna be starting to make money as time goes. But when you're buying options, you have to predict the time perfectly, and because every day as the call is not in the money, it's gonna start to lose its intrinsic value, and then your call will be not worthy enough, right? So let me just make another example quickly. So you can see the Apple is trading at 236, and you want it to go above 240, right? So the price you're paying here, it depends on the intrinsic value it holds for today. But let's say we go half the time, which is 13 days, then the stock price stays the same. Then this value you basically lose half, because the probability of it going above 240 is much less now. But there's also a break even, because since you're paying $6.15 per stock, the break even for you to actually start making money will not be 240. Your stock has to go, Apple has to go to 246 in the next 26 days. So that's a $10 move. And that's because you're also paying this premium of $6.15. So let's say I want to buy this call. Then I'll just do single. And then as you can see, your break even will be 246.15 cents. But your profit can really be a lot, and here that's what delta is, and that tells you for every $1 move how much you're going to make. So for this one, you're going to be making $46 for every move. So if it goes to 241, $46. And that's basically how it works. So let me just tell you a bit more about the combinations you can do. So let's say you are bullish on Apple stock, and maybe you have some information that's going to tell you that the Apple stock is going to raise in the next 1 month. So what you can do is, without putting too much in risk, is maybe buy this 241, but buy a vertical. So what that does is that you're going to be buying the 240 call. So this one, you're going to be paying $650. But then you're also going to be selling the 242.5 call, and then you're going to be receiving $555. And when you subtract that, you'll get a net debit of $111. So you'll have to pay that much. And your max loss will be that much, since that's how much you're going to be paying. But your max profit will actually be 139, and your break even, as you can see, is much less. It's only 241, and therefore it's much better than just buying the single naked call. The only advantage of a single naked call is that the profit is technically unlimited. And let me show you another strategy. And what that basically is you thinking that, okay, maybe Apple's not, this strategy I think only works on indexes and is best on indexes. So let's go to the S&P 500, SPY, this one. And this is the S&P 500 index. It's a bit laggy right now. And as we can see here, it's trading at 296. So here's the put side. And we can trade with a trader that it's going to stay above, let's say, 288. Because the implied volatility for 26 days is only $10 up or down. So 288 will be a good one. And the probability of our success in this one will be 70%. Let's say, okay, let's make it a bit more closer. Let's do the 293 one, and now we have a 60% probability. So now we're going to do sell vertical. Now what this means is that we're predicting our stock to stay above 292.86. So we're going to be paying $36 for this trade, and we're going to have a 60% probability of making $14, our max profit, in the next 26 days. And the good thing about this trade is that time is on our side, and that we will just depend on time. As days pass, our profit's really going to start to build. So a cool way to see this is if you go to the Analyze tab. Here's one of my positions I have. So let's go to Risk Profile. So what I did was that I bought the 283 put and sold the 284 put, and my max profit is 6,200 and my max loss is 13,800. So it's a 50% ratio, and right, I bought it at when it was at 287 trading, and it was a 70% probability of trade. And as you can see right now, the stock is at 296, so we can go to 296, and I'm $4,292 up on this trade. And now you can see all I need is to wait for the blue line shows the expiration date, so another 13 days, and then I'll make my max profit of 6,200. So here you can see that it's all about the time. So even if it's here and you're losing money right now, if you can wait all that time, you'll reach maximum profit. That's about it, but there's one more thing, and that's the most important thing about options trading, guys, and that is implied volatility. It's really important that when you're selling, like as you can see, if I go to the charts of S&P 500, I mentioned this in my last video as well, that you need to be selling options when implied volatility is really high. So let me go to the 20-day one, and you can see that when I sold it, um, this is when I bought it. I bought this contract right over here, and by using my moving averages, I was right on this one, as you can see, and um, that's what I used. So implied volatility was really high. I saw the potential, and that's how my order went in my favor. Because that's basically what options are priced on, and a big part of that is implied volatility. So calls, if you're buying calls and you want to have a jump in implied volatility, and if you're selling calls, you want to have a move down in implied volatility, and that's what Vega is. There's delta, gamma, theta, and Vega. You can see that in my other videos. I can change this here, and that basically tells the implied volatility. And these are all the factors that move the price of an option, and it's also intrinsic value as well. So there was the 286, and I have to say this was a really good one. Um, it was a really successful trade, and I'm glad that it worked. Implied volatility is high, but now since implied volatility is low in the 30 days, here I can maybe buy a vertical spread for a bullish trade, because I see a pattern here, and I think it's a great opportunity to buy a vertical. And another trade you can do, I would suggest, is an iron condor, and that's where you're directionless, but you're predicting the price to stay in a certain period of time between two ranges. So let's say 300 and 294, you're predicting, and that's how you make a profit. I've made another video about that, and make sure to go check those out. So that's basically it, guys. And yeah, so let me just maybe discuss some terminology. So what we use to discuss the price of the option is called strike price, and your strike prices, and expiration date. Maybe you've heard of that word, are these dates here. And that's about it, guys. If you have any questions, please let me know. Thank you guys for watching, and I'll see you guys next time.